Good afternoon. Friday looked like nothing happened. The S&P 500 finished up less than 4 points, crude oil fell back under $100, and the strikes on Iran stopped. Calm. Underneath it, two numbers landed in the same week that do not belong together. Bank of America's bull and bear indicator ticked up to 9.6, its highest reading since 2021, deep in what has historically been contrarian sell territory. And cash levels in the bank's fund manager survey fell to 3.6%, a historic low. Investors have never been less liquid. At the exact moment they are telling that same survey an artificial intelligence bubble is their #1 risk. And at the exact moment the semiconductor complex started breaking underneath a flat index. The market did not run out of reasons to be bullish. It ran out of dry powder. Let's take it in order. Here is the board, and the spread between these numbers is the whole story. The S&P 500 closed Friday at 7,411, up 0.05%, essentially flat. The Nasdaq Composite fell 0.6%. The Dow rose almost 0.5%, adding 235 points. But the technology sector fell 2.37% that same session, while real estate and financial stocks led the gainers. Brent crude settled near $96.78 after falling about 4% on Friday. Bitcoin sat near 64,300, with Ether near 1,860 and falling faster than Bitcoin as higher yields pulled money out of risk assets. The 10-year Treasury yield is 4.69%, the highest since January of 2025. And gold is around $4,052, parked just under 4,100 against a firmer dollar and those higher yields. Hold on to one thing from this board: the index did not move. Everything underneath it did. First read, consensus says Friday was fine because the index was flat. The tell says the index was flat because something took over, not because nothing happened. Technology fell 2.37%. Intel dropped 6.5% on an earnings beat. SanDisk fell nearly 11% with the memory chip group. Real estate and financials led the gainers. An index that goes nowhere while its leadership sells off is an index in the middle of a handoff. And handoffs are precisely where crowded positioning gets discovered. High conviction on that one. Second read, and this is the one that names the issue. Consensus says positioning is bullish, and bullish is good. The tell says positioning is past bullish and into no exit. A 9.6 bull and bear reading and a record low 3.6% cash allocation mean the marginal buyer has already bought. That is the mechanism that turns an ordinary 5% drawdown into a disorderly one. Nobody has cash left to catch it. And the same survey says these investors already believe artificial intelligence is the top tail risk in the world. They are not unaware. They are aware and fully invested. That is the definition of an asymmetric setup against risk. High conviction on the setup, deliberately no call on timing, because extreme readings historically precede drawdowns reliably, not immediately. Third read, consensus says Charles Schwab endorsing the Clarity Act is the crypto catalyst. The tell says the institutions are arriving into a bear tape, and the catalyst itself is slipping. Schwab, with about $13 trillion in client assets, calling the bill a really important fundamental catalyst that needs to pass, is a genuine milestone. But Bitcoin sits near 64,300 and Ether near 1,860, with Ether underperforming Bitcoin by a wide margin on the year across every source we checked. Meanwhile, Senate leadership expects the bill to miss its window before the summer break, and the White House advisor on this is only slightly more optimistic about the first week of August. The 2026 crypto thesis is regulatory plumbing, not price. And plumbing takes longer than a news cycle, medium to high conviction. Now follow the money, because the whole macro picture runs through one variable. Oil, because oil sets the Federal Reserve. Brent's run to $100.69 on July 23rd, its first triple-digit print since May 26th, was not really a commodity story. It was a rate story. It pushed the 10-year Treasury to 4.69%, on straightforward inflation math. And it dragged September rate hike odds from under 53% a week earlier to somewhere between roughly 2/3 and over 80%, depending on the read you take. That is an extraordinary repricing for a single week, and it happened under a Federal Reserve Chair, Kevin Warsh, sworn in this May, whose stated position is that inflation is a choice. Then Friday it partly unwound. President Trump paused the strikes after 13 consecutive nights. Omani officials flew to Tehran to negotiate reopening the Strait of Hormuz. Brent fell about 4%, back under $97, and the bond market's inflation scare got a reprieve. But look at the foundation. Reporting attributes the pause partly to the United States running low on munitions rather than to a diplomatic breakthrough. That is a materially weaker basis for de-escalation than an actual agreement. Traffic through Hormuz is still down sharply since July 8th, and the blockade is still tightening. The risk premium came out of the oil price faster than the risk came out of the water, which leaves the dollar and gold telling the more honest story. Gold parked just under 4,100, elevated, waiting. On sentiment, across market and social sentiment monitoring this weekend, the conversation is split three ways, and the split itself is informative. The loudest cluster is geopolitical, arguing over whether the Iran pause holds, with prediction markets pricing the negotiation extension close to a coin flip. The second cluster is the artificial intelligence financing argument, which got much louder after Michael Burry added to his short position against Nvidia at $210.28. His claim, and I want to be precise, that this is his stated thesis rather than an established fact, is that a meaningful share of chip demand is financed off the balance sheet and undisclosed, in what he describes as a circular arrangement, citing this year's Bank for International Settlements annual report. The third cluster is policy, where an open weights letter signed by 25 American technology companies on July 24th is being recast in circulation as a fight about banning open source entirely. It is worth being careful there, because two different policies are being fused into one. Restricting Chinese origin models is the question actually on the table. A blanket ban on open source is not. The common thread across all three clusters is the same as the tape: stated fear, unhedged books. That brings us to the tell. Cash 3.6%, a historic low. Everything else this week is interpretation. This one is arithmetic. Fund managers hold less cash than at any point in the survey's history, while simultaneously naming an artificial intelligence bubble their top tail risk. Both things are true at once, and that combination is the whole issue. The market's stated fear and its actual positioning have fully decoupled. Fear that is not hedged is not fear. It is commentary, and commentary does not cushion a drawdown. Sectors in play: semiconductors and memory. The bull case is that Intel beat. The bear case is that Intel fell 6.5% anyway, SanDisk fell 11%, and the sector fell 2.37%. The read is that when a beat gets sold, the market has stopped paying for results and started repricing the multiple. That is the tell that matters most this week. Energy. The bull case is that the entire inflation impulse eased with Brent's round trip. The bear case is that mines and a blockade are physical, while a pause is a decision. The read is that this is the single variable deciding the bull-bear tie, and it is the one least under anyone's control. Financials and real estate. The bull case is that they led Friday's gainers, which is real breadth. The bear case is that rate-sensitive sectors leading with the 10-year at 4.69% is a bet on the Iran pause holding. The read is that the rotation is doing the index's work, while technology re-rates. On the radar, Monday, the 10-year open, which is the cleanest read on whether the Iran pause is believed. Back below 4.6% says the market bought it. Also Monday, semiconductors, where after Intel and SanDisk, we find out whether Friday was a one-off or the start of a derating. Tuesday and Wednesday, the Federal Reserve meets, with the decision Wednesday at 2 p.m. Eastern. Consensus is a hold at 3.5 to 3.75%. This is not a projections meeting, which means the language is the entire event, and Chair Walsh's read on the oil inflation impulse is what September trades on. Ongoing, Brent and transit through Hormuz because the mines are still in the water. And in the first week of August, the Clarity Act floor timing, with August 7th as the working deadline for a 2026 path. The scorecard, 4 new falsifiable calls dated today. 1. Positioning not valuation is the transmission channel for the next drawdown. That is falsified if the S&P draws down more than 7% from here without cash allocations rising above 4.5% on the way. 2. The oil risk premium is not fully unwound. Falsified if Brent closes below $88 before August 15th, with Hormuz transit still impaired. 3. The Clarity Act misses the pre-recess floor window. Falsified if the Senate takes a floor vote on or before August 7th. 4. The semiconductor re-rate is a multiple event, not a demand event. Falsified if the next two major semiconductor reporters miss on revenue, rather than beating and selling off anyway. And grading since the last update. Last issues read that the large-cap technology sell-off was a funding model repricing rather than a demand problem held up. Intel beat on demand this week and still fell 6.5%. Same pattern 1 week later. And the close, every investor in that survey can tell you the artificial intelligence trade might be a bubble. They said so. It is their number one named risk, and they are holding the least cash in the history of the survey. So what is it worth to know something if you are positioned exactly as though you did not? That is not a prediction about next week. It is a question about what conviction actually costs. We will be watching the 10-year Monday morning and Chair Walsh's language Wednesday afternoon. This has been the Asymmetric Daily Brief. Research and educational content only. Nothing here is personalized investment advice. The asymmetric signal, one contrarian read a day. Subscribe.